So just like everyone else, my portfolio is not doing well in the month of November. We were sitting just below 280, and now we're sitting just below 260, which is a part of the game. That's how stock market is, and let's talk about managing, because that's exactly what I had to do the last 2 or 3 days, is manage the portfolio. And it's fine, but for people like me that use margin, right, you have to be very careful. You have to be very careful, make sure you're not over leveraging, because the money that you're getting on margin isn't free money to use. Once you go into actual margin, like you went past all your cash, you're going to start owing interest on money. And then that happens way faster if the market starts dipping, because all those plays that suddenly become not profitable or not green, Fidelity, Robinhood, whatever platform you're using, is now going to look at you as a liability, and they want to make sure that you'll be able to pay if you have to. So they'll house call you, and they're going to make you put more money into the account or close out your account, close out positions. Like, that's just how it is. They have to be safe for themselves. I get it. It's a business. So in doing so, dropping 20-ish, 20 plus K, 22K, right, in a short amount of time puts my account at risk. So since I've been house called before, I know that once it started dipping to certain levels, and certain levels could be anything for anyone. I just personally don't like seeing a certain things happen to my portfolio, my buying power moves and all that. So I started closing out a lot of plays. I closed out some HIMS plays at 57, 52. I rolled out my covered call for Tesla, and the question would be, how do I know which plays to close out? So if you guys have been following me for a while, almost all my plays have been winning plays where you collect like 100% of the premium and then you go about your day. But in this case, where you're looking for exits to make sure your cash is good, right? What I did, I looked through all my plays and I saw which option plays where I've already collected more than 60 to 70% of the premium. So that might confuse a few people, because don't you collect the premium up front? Yes, you do, but then you still have the time frame for it to expire, right? So even though if you collect $1,000 up front for a month, if you had to buy that contract back to close it, you have to pay a little bit of money, right? So if you had to pay $200, you made 800, right? So you made 80%. So that's how the calculation works in simplest terms. So I looked for everything above 60 and 70 and the closest expiration date, and then I started closing out things. Yes. Okay, I'll change it in a second, bud. Give me 2 minutes, okay? And then once I saw all of that, then I started to close them out so it would free up cash. And once you free up cash, did I make a play right away? No, because I expected more of a dip. So I don't want to put more money back into the market to put my account at risk, right? So if you notice on my trades, you're just seeing me close out plays, and I'm not making too many, even though I made one. Like, I ended up being up 3 grand last week. And then I made a play for 2 grand this week, even though I was saying no, November's going to be a tough month. So I was technically up 5K, but then because I rolled my Tesla play, my 305 cover call for next week, 305, if you notice, Tesla's like at 400, because it had a crazy crash from like high fours, I decided to roll it to a 405 for 1128, which I think, in my opinion, is a good play, even though I had to pay around 8K for it. So that technically puts me to negative 3K. But then the swing of this is on November 28th, if Tesla is above 405, I quote unquote made 10K, but minus 8K. So it's actually a net profit of 2K, which is fine, because then that will mean I will have 40K up to use for cover calls and cash secured puts starting November 28th for like a potential Santa rally. If this market continues to dip, usually around Christmas, the market will continue to go up. And then got to continue to manage plays. So there's a question here from Sam's in the Discord. Will you share your thoughts on how you'll handle lower strike cover calls on HIMs as weeks progress? I'm in the same boat with assigned shares at much higher valuation than where we are trading right now too. So this is what I go over a lot. I don't fully go over it in the course. I do touch upon it, but in the Discord, I go over, like, say if a stock went to 50 or 48. Give me 1 second, but I will. Okay, I will. Sorry, I'm gonna give my son a snack in a little bit right after I make this video. But the whole point is, like, if the stock is trading way lower right now, like say HIMS was, you were assigned to HIMS at 50 and now it's at like 38, what do you do? It's like, you don't got to overthink this. It's pretty simple. If I could bring up Robinhood real quick here, just the easiest to show. Hopefully it doesn't make me have to log in a million times. Okay, HIMS. Okay. All right, so let me make sure that we are on. Okay, there we go. HIMS. So trade options, right? Sell, call. What would I do if we're at 35 and we bought at 50? I would pretty much just go out a month or 35 days, and I would see what 50 looks like. To be honest, I would just see 50. You'll get paid $60, $62 to make this cover call. Is it a lot of money? No. Is it better than just holding the shares and doing nothing? Yes. So you could do that, 50, and just by December 19th, you'll get $62 and just be happy with bringing down your cost base because you're collecting $62 per contract. If you wanted to be a little bit more quote unquote risky, you could actually go anywhere below. Check the Bollinger Bands, see where you are on them. See if you're at the bottom Bollinger Band, see what the midline is and play around there. And just to say, maybe if the midline was 45, maybe you could be getting paid 115 or 125 at 44. Just know that if HIMS makes a significant run up and goes past your strike, then you'll be selling for a loss of $5 per share. Because if you bought at 50 and you did your strike at 45, yeah, you'll collect the 115, but you'll be selling for technically a loss. And for the people that do this in a taxable brokerage account, make sure that it's past a month. So if you do sell it like this, it's not considered a wash sale where you could actually write it off against your taxes. So you just have, these are the things you just got to like look at and see where you want to be. I personally, if you're new, I would just stick to playing at your cost basis, not more than 30 to 45 days out. And at least you know you're picking a strike price where you can't lose. Because if HIMS ran up past 50, at least you're selling right where you got assigned and you came out on top with a few bucks. That's the safest way to do it. That's the safest way to make sure you win, right? If you want to make a little bit more money and play a little bit more risky, you go between your cost basis and what the stock price is. And you could do that, which is fine. And just know that everyone's risk tolerance is different. And if you want to do that, that's on you, pretty much. Do I do it? I do. But I do it off technical analysis, and I still play it closer to my cost basis, just in case there is a significant run up. So that's my mindset around it. And again, none of this is financial advice, but that's exactly how I do it. I try to make a little bit more money, and I usually have more than one contract. So at least I'll still be making something bucks for like 2 contracts if I did it at 50. But that's just the way you have to look at it. And that's how you just got to do it. And my kids are crying, so now I got to go. So thanks for watching. I'll see you guys very soon. Peace.